FHA mortgages versus conventional, what every first-time buyer must know. One of the most common questions I get from first-time buyers is, should I choose an FHA mortgage or a conventional mortgage? The answer depends on your financial situation, your credit history, how much money you have available for a down payment, and your long-term financial goals. Today we're going to talk about what FHA and conventional mortgages are, how to qualify for each, the pros and cons of both, what a mortgage payment actually includes, the differences between PMI and MIP, and why an FHA mortgage can end up costing you a lot more money if you don't understand how it works. Let's get started. What is an FHA mortgage? An FHA mortgage is a loan insured by the Federal Housing Administration. The government doesn't lend you the money directly. What FHA does is insure the loan for the lender, reducing their risk and allowing them to offer financing to people who might have trouble qualifying for a conventional mortgage. FHA mortgages were designed to help buyers who have lower credit scores, less money for a down payment, limited credit history, fewer savings available. That's why FHA is often very popular among first-time buyers. General FHA requirements. While requirements can vary by lender, FHA generally allows credit score from 580 with a minimum down payment of 3.5%. Some lenders allow lower scores with additional requirements. Down payment, minimum 3.5%. Debt-to-income ratio, generally more flexible than conventional loans. Occupancy, the property must normally be your primary residence. FHA advantages, more flexible credit requirements, lower down payment, easier to qualify, more tolerance for past credit issues, excellent option for buyers rebuilding their credit. FHA disadvantages, requires MIP, has loan limits, may have stricter requirements on property condition, can be more expensive long-term, and this is where many buyers make a costly mistake. Let's talk about MIP. What is MIP? MIP stands for Mortgage Insurance Premium. All FHA loans require mortgage insurance. There are two types. Upfront MIP usually equals 1.75% of the loan amount. Most buyers finance this cost into the loan. Annual MIP paid monthly as part of the mortgage payment. And here's the detail many buyers don't know. On many FHA loans, MIP can stay for the entire life of the loan unless you refinance into another program. That means you could be paying mortgage insurance for decades. And that's precisely one of the reasons why an FHA mortgage can end up being significantly more expensive than it first appears. What is a conventional mortgage? A conventional mortgage is a loan that is not backed by the government. It generally follows the guidelines set by Fannie Mae and Freddie Mac. Because the lender takes on more risk, the requirements are usually stricter. General requirements for a conventional mortgage. Credit score, normally 620 or higher. The higher your score, the better the terms and rates available. Down payment can be as low as 3% for certain first-time buyers. Many people mistakenly believe they need a 20% down payment to get a conventional mortgage. That's not true. Debt-to-income ratio, usually a bit stricter than FHA. Financial profile, generally requires a stronger financial situation. Advantages of a conventional mortgage, lower long-term costs, no upfront mortgage insurance premium, greater flexibility with some property types, ability to remove mortgage insurance in the future, potentially lower monthly payments long-term, and this last advantage is extremely important. What is PMI? PMI stands for Private Mortgage Insurance. PMI protects the lender when the buyer puts down less than 20%. Like MIP, it increases the monthly payment, but there's a very important difference. PMI can be removed. When the property value increases or when you reduce your loan balance enough, you can remove PMI. In many cases, automatic removal occurs when you reach approximately 78% loan-to-value, LTV. You can also request removal around 80% loan-to-value. This means your monthly payment can eventually decrease. Unlike FHA MIP, PMI is usually temporary. And for that reason, a conventional mortgage is often less expensive in the long run. Disadvantages of a conventional mortgage: stricter credit requirements, harder to obtain for some buyers, less flexibility for complicated financial profiles, may require larger financial reserves. What does a mortgage payment actually include? Many buyers think a mortgage payment consists only of principal and interest. That's not always true. Most monthly payments include several components. Principal, the portion that reduces your loan balance. Interest, the cost of borrowing the money. Property taxes, usually collected monthly through an escrow account. Homeowner's insurance, also usually collected monthly through escrow. Mortgage insurance, when applicable, PMI for conventional loans, MIP for FHA loans. What is usually not included? Depending on the property, the following are normally not included: homeowners association, HOA fees, utilities, electricity, gas, water, internet, maintenance, future repairs, pest control, landscaping, snow removal. These expenses should be considered separately when calculating your budget. Many buyers think their payment will only be principal and interest, ND $2,000, but the actual payment could look like this: principal and interest, ND $2,000 taxes, ND $500 homeowners insurance, ND $150 PMI or MIP, ND $125 total payment, ND $2,775. That's why it's essential to understand the difference between the basic mortgage payment and the total monthly cost of homeownership. Which is better? There is no one-size-fits-all answer. It all depends on your situation. FHA can be an excellent option if you have more limited credit, you have little money for a down payment, you need more flexible requirements. Conventional can be a better option if you have good credit, you can qualify for better rates, you want to remove mortgage insurance in the future, you're looking for lower long-term costs. Final thoughts. FHA and conventional mortgages are both excellent tools. Neither is automatically better than the other. What's important is understanding credit requirements, down payment, PMI, MIP, loan to value, long-term costs. Because sometimes the easiest loan to get today isn't necessarily the most affordable 5 or 10 years from now. And in many cases, spending a few extra months improving your credit can save you tens of thousands of dollars over the life of your loan. The goal isn't simply to qualify for a mortgage. The goal is to choose the mortgage that best supports your financial future. Thank you for watching this video, and I wish you great success on your journey to homeownership.